In this video, we're going to walk through how to determine the cost per unit under absorption and variable costing, and how that then translates into the value of our ending inventory. So in the example given, it tells us that the most recent year, the Judson Company had the following data associated with the product that it makes. So they started the period off with 300 finished completed units in their beginning inventory. They produced 15,000 units and they sold 12,700 units at $300 per unit. The variable costs, they had direct materials, direct labor, and variable overhead. They also had fixed costs. They had fixed overhead per unit produced of $30, and they had fixed selling and administrative expenses of $140,000. So in brief exercise 321, we're going to be focusing on absorption costing first. When you're thinking about absorption costing, think of it almost like a sponge. It is absorbing all of the costs that are related to a product cost, meaning all of our direct materials, all of the direct labor, and all overhead, regardless if it's variable or fixed. It's including all of those components as part of the product cost. Absorption costing is the type of costing that we are required to use for financial reporting purposes. So under absorption costing, we also do a traditional income statement because that's what we would see reflected in our financial statements. So in the first piece, they want us to figure out how many units are in ending inventory. They then want us to, using absorption costing, calculate the per unit product cost, and then what is the value of our ending inventory under absorption costing. So the first thing that we have to do is calculate how many units are in ending inventory. They gave us some information. We had units that were in beginning inventory, and they told us that there were 300 units in beginning inventory. We also had units that were produced during the period. There were 15,000 units that were produced, and then there were units sold, and that we sold 12,700 units. So we take our units that we started with, the 300, we add the units that were produced of the 15,000, and we subtract away the units that we sold in order to determine how many units we have in ending inventory. So we have 2,600 units in ending inventory. Part 2 asked us to determine the per unit product cost, again, under absorption costing. Again, when you're thinking of absorption costing, think about that sponge. It's sucking in all of those components of product cost that we've been talking about since the last chapter. So we look at the direct materials, and again, we're looking at it on a per unit basis. So our direct materials was $20 per unit. Our direct labor was $60 per unit. Our variable overhead, they told us, was $12 per unit, and our fixed overhead, they said, was $30 per unit. So in total, that means under absorption costing, we have $122 per unit product cost under absorption costing. In part 3, they asked us to determine the value of our ending inventory. So in order to do that, we simply take how many units we have in ending inventory, the 2,600, and we multiply it by our per unit product cost of the $122. So in total, we have an ending inventory value of $317,200. The key difference between absorption costing and variable costing is going to be how we treat our fixed overhead. Under absorption costing, it allocates out a portion of that fixed overhead to the units that are sold in the form of cost of goods sold, and the units in our ending inventory, again, it's adding to our balance sheet value. In brief exercise 322, they want us to go through the same process, but now they want us to use variable costing. So we're going to do the same piece. We're going to look for how many units are in ending inventory, calculate our variable costing per unit product cost, and then what our value of our inventory is under that variable costing. So our units in ending inventory, same process. Units in beginning inventory haven't changed. We still had 300 units in beginning inventory. Units produced, we still had 15,000 units produced, and we still sold 12,700 units. So no matter which method you're using, the amount of units that you have in ending inventory is going to be the same. It's the 2,600. But we need our per unit cost under variable costing. And so when they're looking for the per unit product cost under variable costing, we're only going to include the variable components of product cost. So our direct materials we know is variable because the more units we produce, the more materials we are going to need. So that's $20. Direct labor is also variable. The more units we have to produce, the more direct labor hours we're going to need. And any variable overhead is going to be included as well. So in this case, our per unit product cost under variable costing is $92. We do not include the fixed overhead because under variable costing, it views fixed overhead as basically a cost to stay in business. We know what fixed costs are. They're costs that stay the same regardless of the level of output. So even if the company never produced one product or never sold one product this period, fixed overhead costs would still be incurred. So under variable costing, they feel that it shouldn't be included in here because those costs would be there regardless of how many were produced or sold. So our value of our ending inventory, once again, we're going to take how many units we have, the 2,600, and multiply it by the $92 per unit product cost value for a total of $239,200.